Okay, good morning, everyone, and welcome to Macro Ace with your host, Tony. We'll be going through non-farm payrolls, but also the Canadian employment change data. So let's get straight into it. We've got an earlier start than usual. So let's get into what non-farm payrolls is all about, why it's important, and what to expect, and what the current sentiment is around it. So what is non-farm payrolls? So it is the net amount of jobs that are created within the prior month. It doesn't show you how many jobs were actually lost. That's what the JOLTS job data does for the uh, month before this data. So again, it just shows you the total amount of jobs that have been added, and one of the reasons why it's a key economic release to watch as to how well the labor market is doing in the US. If it's doing really well, then of course the rest of the economy is going to do well. When there's more spending available to those consumers that are in jobs, then of course that brings up demand for other products and other services and goods, and also that also brings up inflation too, as that spending increases with more money in hand. So the key difference then is there's a household survey and there is the establishment survey. Okay, so the household survey measures the unemployment rate. So it queries people saying, are you unemployed? If you are employed, are you part-time or full-time? And that's what the household survey is. Whereas the establishment survey, the key difference being is that the establishment survey surveys about 440,000 different businesses that there are within the country and ask them how many people they have on their payrolls. That's it. So you have the more reliable bit of data, which is the establishment survey itself, because businesses have access to data and clearly know how many people that they have on their payrolls, rather than asking a consumer or an individual whether they're full-time or part-time employed. But that's what takes the precedence, or is the most watched part of the report. And that's where the non-farm payrolls figure comes out from itself, as does the private payrolls and the manufacturing payrolls data as well, and also the government payroll data. Then, how does it affect the market? So, normal market conditions with currency, when you get a stronger than expected reading from non-farm payrolls or an overall better jobs report, then that is bullish for the currency. You usually see some upside because the economy is doing well. Businesses are able to add more jobs to their businesses, so that means that they're spending more money and that there is a healthy pickup there. So for currencies, usually you see a positive reaction if you get an outstanding or much better than expected reading for non-farm payrolls. For stocks in a normal market environment, when there isn't any central bank tightening and the central bank isn't focused on trying to slow down growth in the economy and bring down inflation, usually what happens for stocks is that, again, same thing. If you see a much stronger than expected report, then you would see stocks see an appreciation instead. Of course, again, it goes back to if businesses are able to hire more people, then there is a demand for the goods or services that they're providing. So in that turn, that they will need to hire more people in order to do that, and it shows that the finances are quite strong, making stocks more attractive. Then for bonds in a normal environment as well. So for bond prices, if we're considering when the economy is doing really well, that there isn't any indication whether the central bank is going to tighten monetary policy, and we're in a normal environment, or let's say neutral, where there's no tightening, of monetary policy, and there's no easing monetary policy. So for bonds, if you do get a strong report or a strong labor market data, then bond prices usually see movement towards the downside. They see a depreciation or a bearish reaction to the report. The main reason being is if you're going to invest, the only reason why stock traders or other traders would invest in bonds a lot more would be if the economy is shown to be faltering or losing its ground, losing its footing, and there is a fear that there could be a recession, and then those traders who typically trade in risk assets would jump to the safe haven assets, the safe haven asset of bonds instead. So that's the key thing to bear in mind, the normal market reaction. Now, of course, that's different, and that has been for quite a while now, since we've had the central bank tightening phase. So for stocks, when we've seen a very positive report from non-farm payrolls and it's been very strong, the market reaction has actually been bearish for stocks because it's the anticipation that the central bank will tighten monetary policy and hike interest rates. And off the back of that, of course, if you hike interest rates, then that means borrowing costs go up as well, and paying back a loan, the cost of that also goes up as well. So that's something that we've got to bear in mind, is that what we've recently seen is that stocks have reacted negatively to positive non-farm payrolls data. Saying that though, and we'll go through it at the end when we look at the market reactions from non-farm payrolls for last time, key focus for the markets is inflationary pressures. So wage prices had slowed down a little bit last month, or the report we had last month, and then we had seen the S&P 500 after its initial move towards the downside see some strengthening, because it's the idea that if inflationary pressures and wage prices are slowing down, then the Federal Reserve is going to be less likely to hike by a bigger amount or tighten monetary policy even further. So that was a key reaction for stocks, and we'll go through the market reactions later on, and also the deviations. Now, the indicators weighing on sentiment, or where the economy is at the moment. So you have CPI, that was at a fresh 40-year high at 8.6% year-on-year versus 8.3%, and then you had the Fed taking their 75 basis point rate hike the following week, off of the back of the surprise data from inflation from the CPI report. The PC price index at 6.3% versus a prior of 6.3%, so there was a slight slowdown there in that there. The core PC price index also had seen a slowdown to 4.7% versus 4.9%. GDP quarter one, the final reading came in at minus 1.6%, so worse than the, of course, now comparing it to the fourth quarter 2021 of 6.9%, that had done pretty badly. Now, the markets wouldn't have reacted to the data so much because they had already seen the advanced report, which is what they reacted to the most. And off the back of that, he'd seen not only the dollar weaken, but also he'd seen the S&P 500 weaken and gold seeing appreciation towards the upside instead. Off of that worse than expected GDP data. Unemployment still above pre-pandemic levels at 3.6%. Remember, the pre-pandemic level will be 3.5%. So some economists are expecting it to tick up to 3.7%, but overall, the median forecast is for it to remain unchanged. So now nobody's really expecting the unemployment rate to tick down, because the last two reports that we were expecting it to tick down didn't happen. It stayed at 3.6%. So the ISM Manufacturing Employment Index as well at 47.3 versus 49.6. So employment, again, a key measure of how the employment situation is in the manufacturing sector. Very important in the US. Did see some further movements towards the downside. So maybe hiring isn't as strong as it used to be. Remember, that's only 1 month better data. But of course, the prior data to that, we had gone into a contractionary mode. Remember, anything above 50 for PMI data shows we're in an expansionary mode, and anything below 50 shows that we're in a contraction mode. So that's one thing to bear in mind with the employment index. Then initial jobless claims this week, we had 235k versus 231k for the prior. And US job openings, which we had this week, was at 11.254 million versus 11.4 million. And then the employment costs, which we'll get out at the beginning of the second quarter, but this for Q1 at 1.4% versus 1%. Then the triggers then for non-farm payrolls. So what are we looking for then? So according to economists, they're looking for a high estimate of 400k is where they would expect the actual figure to come out. And then a low estimate of 180k. Now, bear in mind, the current median forecast or median estimate is 268k. So they're you're looking for about 100 and around 130k deviation from from the forecast figure to the actual figure on the high end, and then about 120k on the low end of a deviation. So we've kind of had a look at, of course, we used to have the forecast or deviation of about 300k when sentiment was quite strong with Russia and Ukraine, and there wasn't that much of a reaction. But now that that sentiment isn't as strong, we're looking for a lower deviation of about 100k, at least 100k either way for the non-farm payrolls figure. The unemployment rate also median, or the highest estimate, they're looking at 3.7% with a low of 3.5%. Average hourly earnings with a high of 5.3% and with a low of 5%. So remember, the current forecast for the average earnings year on year is 5% of the median estimate, and then the prior for that is 5.2%. Then for private payrolls, high estimate of 320k with a low of 170k. Okay, so investment bank views them. Where do they see non-farm payroll figures coming at? So JP Morgan sees 275k with the unemployment rate at 3.6%. BNP Paribas, they see 230k with the unemployment rate remaining unchanged. Bank of America sees 325k with the unemployment rate tick down by 0.1%. Okay, then the previous report that we had seen, so employers in the US hired at a rapid pace in May, while wage gains remain stable, indicating that the economy is still moving forward as the Fed raises interest rates at a rapid pace to cool red-hot inflation. And employers had success filling open positions during the month as well. So could that mean that actually, because wage prices are starting to stabilize, the only reason that would happen is that if the people who are applying for those jobs, that they're actually not looking, that there is a less of a demand for higher wages, because there still is a very tight market in the US, that there are a lot of jobs available, but not enough people to fill those positions because of the wage, because of course inflation affecting everyone, and they want a higher wage to kind of cover that. Now that's starting to slow down, where people are actually but there's more people taking those jobs, and you're seeing the wage prices or the average earnings start to tick down a little bit, start to cool at a stable pace. But again, so that was what caused the S&P 500, as said last time, to see a movement towards the upside. If some people were confused as to, hey, maybe a positive non-farm payrolls figure is good for the S&P. We're not out of the hairs yet. We're not out of the hair yet. But that's what happened in the previous report. Now, Fed and government views. So 3rd of July, you had White House's Kirby citing a strong labor market, saying the US is not in a recession. And that 29th of June, we had Fed's Mester, one of the voters, who said that the US labor market is incredibly tight and lifting wages. 28th of June, you had Fed's Daily saying that the labor market is strong right now, despite layoffs. If you're in tech, you'll be able to continue to get jobs. Fed's Powell on 23rd of June has said that it is significantly more challenging to bring down inflation without impacting the labor market. So bearing in mind, of course, if borrowing costs start to rise, then there'll be less investment in creating more positions to keep your productivity up, or to try and bring it back up to where it was to pre-pandemic levels, or to sustain that momentum. So that's what Powell is citing there. But overall, you're seeing a positive image being presented by the Federal Reserve and the government, that the US economy isn't in recession and that things are still going quite well. So that was the Fed and government views then. And then the other views and sentiment as well. So you had BMO on June the 3rd saying that the jobs report will provide mixed feelings for the Fed, which will welcome the steadier jobless rate, firmer participation rate, and possible softening in wages, while worrying that the economy is still running too hot to convincingly drive inflation back to target. That was according to a senior economist back then. So that was before that report that we had for non-farm payrolls, just as a kind of an expectation. So again, the key thing was the possible softening in wages that the stock traders are keeping an eye on. other than the employment data, the non-farm payrolls figure itself. So I think that it's going to be the key thing today as well. If we do see a tick down in the average earnings year on year, and also it'd be a bonus with a month on month, then we could potentially see the reaction that we had seen last time with a bit of strengthening on the S&P 500 after the initial weakening that we had seen from the better than expected data. Hey, Galaxy One. Hello. Good to see you again. So, key thing is, as I said, you can't look at one figure. And for non-farm payrolls, it's notoriously volatile. And because there are so many people that trade it and so many people that look out for how well the US economy is doing, they base it on non-farm payrolls for that month. So, you've got to understand that the unemployment rate is also a key thing to factor in. And as I said, the average earnings year on year is also a key thing to factor in. You're not going to get a very nice reaction if you have mixed bit of data. There isn't really a clear direction. And if you say you can kind of predict where the non-farm payrolls figure is going to be, or what it is going to be, then and you're sure of it, then good luck to you. But again, that's one thing to remember. You can't just look at one figure or the headline figure itself. You've got to take the other figures into consideration. So let's look at the previous market reaction then. So if I'm showing you here about less than 10 seconds before the release for June 3rd, when we had the data. So we're looking at 10-year bonds, bond yields, dollar yen, gold, S&P 500. So there we go. So you see that pause it there for you. So the dollar had seen strengthening there. The S&P had seen an initial weakening or movement towards the downside. The key reason being for that is that you had the non-farm payrolls figure, which had about a 72k deviation. Okay, and that had meant that, of course, there are more jobs that are being added, and FXpert says, "I'm ready to make money, Galaxy." Tony makes the call, I make the trade. Please don't. Don't. Please don't do that. But hey, if it helps you, then good. So, non-farm payrolls, again, was much better than expected, the headline figure itself. And you'd seen the dollar see some movement towards the upside. As I said, there's about a 72k deviation. Hence, we'd seen that initial weakening towards the downside on the S&P 500. But if we see later on, and on the same candle as well, you'll see that the S&P 500 reverses that and actually starts moving towards the upside instead. There we go. So the reason why it moved up is because the average earnings year on year was in line with expectation and wasn't better than forecast. Okay, so that's what we've got to bear in mind, is that if average earnings or wage prices start to tick up further or higher than their forecast figure and don't come in line with expectations, you'd expect further weakening from the S&P 500. But if you see a decline, or it does come in line with expectation, then you probably see a similar reaction here on the S&P 500. So I know somebody said, is a non-farm payrolls figure better? Is a good non-farm payrolls figure good for the S&P 500? As I said, not at the moment. The key reason being is we had that initial weakening from the S&P 500. If we were looking for a positive figure for the S&P 500 for non-farm payrolls, we would have seen, if we did get that, we would have seen a similar reaction at the very beginning on the first candle. Right? It would have gone up at the same time as the dollar yen did as well, but it didn't. So because the focus was, looking at the average earnings year on year, and then taking into account first the higher than expected non-farm payrolls figure itself. So hopefully that makes it clear for you guys, and it makes it easy to kind of. I know the non-farm payrolls figure is, as I said, notoriously a difficult trade to make, and there's an extra volatility that comes around it. But I think just to bear in mind, of course, the key things: if wage prices if they stabilize, if they come in line with expectation or head lower, that would be usually better for the stock market during a tightening phase. But anything higher than that, and if we do get a strong non-farm payrolls figure, then you'd expect, and we do get a stronger report overall, you could expect some weakening from the S&P 500 if we don't get a mix of data, kind of like this here. Okay, so if I keep going on ahead, let's have a look here. Okay, so that was that. Okay, so now let's have a look at the deviations. That's what I want to show you next. Let's skip that. Okay, so the deviations then for non-farm payroll. Here we go. So we had a 72k deviation from the forecast figure, and we had seen initially 39 ticks towards the downside and then 52 ticks up. After about 10 minutes of trading, the S&P 500 was down by about 38 ticks. On the Nasdaq, we'd seen about 214 ticks down and then 145 up. Bearing in mind, this is on the first candle, right? This reaction here. And then after about 10 minutes, it was about 175 ticks down. On the dollar yen, so let's look at what was the biggest mover currency-wise, currency pair-wise. We'd seen, if we're looking at it here, so we'd seen that the dollar yen had seen the biggest reaction out of compared to the other currency pairs. Okay, the main reason being is that at that time you had the Bank of Japan, and recently they've been saying that they're going to continue with their ultra monetary policy easing, and the key thing is they're not going to hike rates or try and tighten monetary policy at any point in the near future. So that had added to some yen weakness. And from that, we had seen a strong reaction on the dollar yen compared to some of the other currencies, because the dollar was stronger at that point and still is, compared to the Japanese yen. I think at that time we were around a 20-year low for the Japanese yen against the dollar. Hence, we'd seen a stronger reaction from the dollar yen. But after about 10 minutes of trading, the dollar yen was up by about 47.5 pips. Initial reaction was 22.5 pips up. Euro dollar, 15 pips down and 5.5 pips up on the first candle, and then 22 pips down after about 10 minutes of trading. GBP USD or cable, 17.4 pips down and about 28.3 pips down after that. And then looking at the Aussie dollar and New Zealand dollar, again, similar sort of reaction there. All of them were down after the data had come out. Gold, again, had seen about 48 ticks down and about 20 ticks up. And after about 10 minutes of trading, it's about 55 ticks up there. And the bonds, we'd seen about 21 ticks down on the 2-year, or for the bond price, off the better than expected data. Of course, bond yields would have gone up. And the 30-year had also seen a similar reaction, where we'd seen 15 ticks down, and then about 10 minutes of trading, we'd seen about 27 ticks down. So the key thing to remember is, I think we're looking for, the market reacted to a 72k deviation. If economists are looking for about 100k deviation for the non-farm payrolls figure itself, we'll look for similar thing as well on our side, at least 100k. For the headline figure. We'd also want to, if we were trading the dollar, we'd want the unemployment rate to tick lower. Okay, we'd want the private payrolls and average earnings. We'd want private payrolls to be higher, average earnings to be higher or stable. Okay, or in line with expectation. If we get if we do get very negative wage price data, there could be a possibility of some initial strengthening from the dollar, but then that might not last too long if we see strong average earnings or average earnings year-on-year data. But considering what we had last time, where the data was more or less in line with expectation, the dollar just continued to pump higher because everything else was more or less positive. For the S&P 500, as I said, you'd want to look at you'd want weaker data with a tick down, particularly in the average earnings year on year. So you'd want that to show a negative reading. So you'd want the inflationary pressure of wage prices to tick down. Of course, that would mean that the Federal Reserve might not take a 75 base point rate hike at the July meeting. Maybe they might do a 50. Powell did leave the option open for a 50 to a 75 base point hike, being dependent on how data comes out. So remember, the next release that we have, I think it's next week, we have CPI for the US. But we just bearing in mind that the Federal Reserve, that their meeting is going to be at the end of the month, okay, of July 27th, 26th to the 23rd to the 27th of July. So we'll be they'll be looking at all this data that's coming through. So if we do get a much stronger than expected data, then that could play into the hand of the Federal Reserve tightening more and maybe sticking to a 75 or confirming a 75 rather than doing a 50. But again, that's one bit of data. So inflation is the key thing. So wage prices is going to be key to look out for. All right, so that's the non-farm payrolls then. We have Canadian employment. We are not done yet. It's a double whammy, my children. I don't know why I'm calling my children. Anyway, so Canadian employment, so it's the same thing as non-farm payrolls, measures the change in new jobs added. Let me kind of skip ahead because it's kind of the same thing. Currency is also the same reaction as we had seen. Better than expected figure, you'd see a strong movement towards the upside. Yeah, children, yeah. Sorry, Casasa Luis. Hey, I look after you guys, you look after me. It all works out. So for bonds, there'll be the same reaction too. Better than expected figure. You just expect to see bond prices to tick down and the yield to tick up, and stocks you'd expect to see a negative reaction too. Now, the previous report, you had employment that increased in both the goods and service producing sectors, which spread across accommodation and food services. And employment growth continued to outpace population growth as the labour market tightens. So on June 14th, you had Canadian labour unions that won some big pay rises of around 3.1%, although it's still lower than soaring inflation. Key thing to bear in mind that inflationary pressures in the Canadian market, Canadian labour market, are also picking up as well. You've got these workers and unions that are wanting a higher wage because inflation is really high, or around is at a 30-year high. Hence, they want to be able to deal with that in the short term. So where is the economy at the moment then? So as I said, inflation rate at the highest since 1991, now at 7.7% compared to the prior of 6.8%. GDP quarter-on-quarter annualized at 3.1% versus 6.7%. The employment change, what we'd seen last time, as said, came out at 39.8k versus 15.3k, so much better than expected compared to the prior month. Unemployment rate ticked down to 5.1% versus 5.2%. GDP month-on-month was worse than expected at 0.3% versus 0.7%, and the S&P manufacturing PMI was also worse than expected at 54.6 versus 56.8, but still in the expansionary phase, not in the contractionary phase for the Canadian manufacturing sector, according to the market, the S&P manufacturing PMI data. Then the triggers then, so economists, they're looking for a high estimate of where they would expect the actual figure to come out at 45k, with a low estimate of minus 48.1k. Ooh, somebody's saying a really annoying beeping sound. Let me hear. Oh no, there is. Hold on, apologies, let me do this. Okay. That should be sorted. Hopefully you're not hearing that buzzing sound coming through. Just going to do a quick sound check on my side too. No, still there. Mic check. I think we'll have to. I think we're gonna have to kind of deal with it for now. We don't have too much time left. Hopefully it's okay. I think I've sorted it there. Anyways, so thank you very much, Christian, for that. Apologies for that sound there. Anyway, so the employment change high estimates of what they're looking for, according to economists, is 45k with a low of minus 48.1k. Bearing in mind that the current forecast that we have for the Canadian employment change is 22k or 22.5k. So looking for about 23k or 22.5k deviation there. Well, excuse me, about 15.5k deviation there for the Canadian employment change. And then the unemployment rate for the forecast of high estimate of 5.3% with a low of 5%. Bearing in mind that the current Canadian unemployment data forecast is for 5.1%, the median estimate with a low estimate of with a prior 5.1%. So it's expected to remain unchanged, but you have here the high estimate of 5.3% and with a low of 5%. Then June 16th, we had Canada's Deputy PM Freeland said a soft landing is not guaranteed as the Bank of Canada acts to cool inflation, but Canada is well placed to avoid a recession. So you're expecting with higher interest rate hikes that you would see depreciation in stock prices, and also that comes along with the borrowing costs rising. So you may see a hit on the employment data. We're not seeing that as of yet so far. Employment data last time around was better than the previous figure, but again we may start seeing worse data in the future. Bank of Canada and current conditions then. So only 40% of the estimated cash flow is being allocated to capital investment. This is for businesses, by the way, from the oil and energy sector, or the energy sector. Businesses are focused on paying back debt and money to shareholders. And also a tight labor market is also seeing a high turnover in the oil field service companies as well. So, of course, Canada's main resources or main finances, money that comes into them, is through providing those natural resources, those minerals and oil and natural gas to other nations as well, particularly the US as well. So those areas of the economy are starting to see higher turnover because they're getting higher wages from other companies instead. So again, if there's if there's people jumping out of those jobs, then that's going to keep pushing up wage prices even further. And then the Bank of Canada Q2 survey, we had that the number of firms reporting capacity pressures related to labor or supply chain challenges is at a record high, and the hiring plans are still strong, and they expect a significant growth in wages and input prices and output prices as well. So regardless of whether the central bank is going to be hiking rates, they still feel that because the labor market is so tight that it'll take quite a long time for that to loosen up, where there will be a slack in the labor market, where there will be more people who are available but less jobs available. Okay, and they feel that those businesses will be able to deal with that and manage it. And so for stock prices, they expect stocks to be able to, of course they haven't said it themselves directly, but they're expecting stocks to be able to weather the storm and be able to, and the currency will see an appreciation off of the rate increases that happen in the future. Then just a little image then from the Q2 survey, just showing you the labor shortages then compared to the intensity. And so we can see here back in 2020 when there was a huge labor shortage, there wasn't that much hiring going on. And that is very bad. Apologies. Well, this is turning out to be a good stream. Well, I know I've gone through most of it, so hey, again, apologies. So you can see here that there is you can see that there is a high intensity of labor. There's a higher intensity for a requirement of people in different jobs or in jobs, but you can see the labor shortage is also quite high as well. So the key thing is that could possibly or potentially remain quite strong for quite a long time, even with the rate hikes. Of course, with the rate hikes that do happen, that will start to dwindle down, as we're seeing that here at the moment. But it depends on how long that's going to last. So we could start to see, as said, lower employment data figures coming out in the future, but not as maybe not so weak. Then investment bank views. So Citi sees the employment change at 45k, with the unemployment rate to remain unchanged at 5.1%. Bank of America sees 5k for the employment change and the unemployment rate of 5.2k. And BMO sees 25k with the unemployment rate of 5%. We've got about 6 minutes to the release. Okay, so let's look at the previous market reaction. So we've got 6 seconds there till the report. Bearing in mind, this is also collided alongside with the inflation data. So now, what does this mean for the dollar CAD? If we have more of a focus, so here we go, it's dollar CAD. So we had strong Canadian data. It was okay. We also had strong CPI data or strong US data too. So what happened is that for the dollar CAD, the focus has shifted to the to the CPI figure itself, because that, of course, was the key thing that markets were anticipating to remain unchanged. But because it blew expectations and it was much higher than expected, the dollar CAD would more or less focus on the CPI release itself rather than the Canadian employment data. So the same thing is that if we do get really strong non-farm payrolls figure, we could see a similar reaction on the dollar CAD, where the US data is going to take more precedence, even if the Canadian data is very strong. But that's just one thing of one report that we've seen, as I'd shown you there. Of course, with GP CAD, you can see that the Canadian dollar had strengthened off of the back of that data, but for the dollar CAD, it didn't matter. The CPI was the big dog, or the main focus at that time. So same thing, I think we've just got to be cautious and aware of what could happen. Now, somebody asked about gold. Somebody said, come on, son, talk to me about gold, whether we get long or short. So key thing to remember is that, if we're thinking about market correlations, when the dollar strengthens, gold weakens, okay, for economic releases. So, as said, if you do get a much stronger than expected payrolls data, then you would also expect that the dollar would rise, and in turn that could lead to a weaker weaker gold instead. Okay. The key thing to remember is that the inflation reports are more important for gold, or really important for gold at this time in the central bank tightening phase. Let me get my tick strike up and running, and we got the charts there. So we got the S&P, dollar yen. We got GBP CAD, so we can keep an eye for the Canadian release. I don't have the dollar CAD because I think we might the dollar CADs. We're just focused on the US release rather than the Canadian release itself. But that's what had happened last time with the CPI report. So not saying that's going to happen again, just saying that that's what we'd seen last time, going off of historical reactions. Some Iqbal says, macro race. Bob's Burgers. Okay, how's my sound? Okay, sound seems to be fine. Well, I apologize to you guys, but we've got about 2 minutes left. Oh, deviations, of course. I want to show you that too. Let's quickly go through that. Bearing in mind that the deviations are available to anyone that subscribes to the mailing list. There we go. So let me get out of the way. Hopefully you can see that. Okay, so there we go. So better than expected data had about about 12k deviation. We were looking for about 15k at least, and then we had seen positive reaction from the Canadian dollar. We can see that GP CAD was the biggest reaction there compared to actually the Aussie dollar CAD was the biggest reaction. Got 1 minute left now. Let's pop this over. Let's bring this back up. Right, got that there. Financial juice, yes. All right, about 30, well, less than a minute, so about 30 seconds left. And I still managed to get through the deviations and sentiment, even with all the sound issues. Hey. All right, about 15 seconds. 10 seconds, less than 10 seconds. Nonfarm Payrolls 372k, 372k, higher than the forecast of 268k. Canadian employment change minus 43.2k, minus 43.2k, lower than the forecast of 22.5k. The US unemployment rate remaining unchanged at 3.6%. Canadian unemployment rate ticked lower to 4.9%, 4.9%, better than the forecast of 5.1%. Average earnings year on year higher than the forecast at 5.1%, 5.1% compared to the forecast of 5%. Private payrolls 381k, 381k, higher than the forecast of 237k. Average work week hours ticked down to 34.5, 34.5, lower than the forecast of 34.6. Average earnings month on month 0.3%, 0.3% unchanged. You have the Canadian participation rate ticked down to 64.9%, 64.9%, lower than the forecast of 65.25%. Manufacturing payrolls 29k, 29k, higher than the forecast of 21k. The US labor force participation rate a tick lower at 62.2%, 62.2%, lower than the forecast of 62.4%. So overall, much better than expected payrolls figures. The average earnings ticked higher as well. Hence, we're seeing the S&P 500 maintaining its move towards the downside. Dollar yen seems to move towards the outside. GBP CAD off of the Canadian data was much worse than expected. Hence, you've seen that strengthening there, weakening there from the Canadian dollar. Let's also have a look at some of the other areas too. Gold, here we go. So gold ticked down lower for the stronger dollar. So Bob's Burgers, that should be your answer there. Hopefully you got it beforehand. Hopefully you did hear it beforehand. But there we go. So gold ticked down lower. Let's look at the bond prices. Bond prices ticked down lower too. So yields are going higher off of the back of that data. 2-year the 2-year there, they're down off of that data. Okay, let's have a look at some of the other areas then. Let's have a look at the Nasdaq. This is probably going to have a similar reaction anyways. Okay. All right. So yeah, same reaction there as the S&P 500. So again, key thing is average earnings. It's the average earnings that was higher than expected. So expected to see a tick down by 0.2% and actually went up by 0.1%. And you had a nice strong payrolls figure. So that's more than 100k deviation there for non-farm payrolls. Hence seeing that continued strong reaction. Right, let's measure some of these then, shall we? Dollar yen. We had a beautiful move, didn't you? Why am I talking to a currency pair? Bit loony. Okay, so that's about 45 pips towards the upside there. Yep, 44.9 if you want to be precise. The S&P 500, how many ticks do we get down? Did anyone trade that release whilst I'm doing this here? Okay, so that's about 64 ticks down. 65. Make sure. Yeah, 65 ticks down. NQ. Was the information that I gave you helpful? I hope it was. It's about 248 ticks down. Or 250. Whoa. Dollar seems is just getting stronger. Yeah, we'll see how well. Seeing a little bit of a reversal here. We'll see how kind of long it lasts. But S&P is seeing some reversal. Gold's more or less cleared its initial move. What is initial? Wow, it's about 130 ticks down. Yowie, wowie. That is pain off of that. GP CAD, so let's look at the Canadian release now. Of course, being the thing. Let's have a look here. Mixed. I'd want to see the market reaction post this stream. My eyes were kind of focused on looking at the dollar yen, the S&P 500. That's about 23.5 pips up. But it's very mixed. Okay, let me look at the dollar CAD. Did it have a reaction? Did it have more reaction? Did it have? Let's have a look. Okay. Yeah, so there we go. So the focus is more on the US data, hence you'd seen a positive move from, you've seen that positive, you'd seen a positive reaction on the dollar CAD. And also to help that positive reaction, you had worse than expected employment change data. So the US is in a better position there compared to Canada. Look at that, huh? That's going to be a mega one. That's about 45 pips. So if you're looking at what I have here at the moment, so what I'm measuring is how strong is how much momentum is there for the dollar at the moment. Okay, or how strong is the momentum or the upside momentum? Now for tick strike, what you can do is you can look at, as I'm doing here, a range of different assets or a range of different instruments that I can kind of look at together to see how well are maybe the stock index is doing. So we have the Nasdaq and the S&P 500. How is the bond market? How much momentum of buying or selling is there in the bond market? So tick strike if you imagine you're in the trading peak, so let's say you're going back to Chicago. Okay. Let's have, if you're going back to Chicago, then we can see, whoops, okay. If you haven't looked at, if you're in the Chicago area, on the Chicago trading block, then you'll know that there would have been a lot of, maybe spitting at people, shouting, buy, sell, get 120, and somebody gives a better price, then you go, dang it. So imagine all that sound is translated into tick strike. So you can hear and also see the order flow too. Of course, I've turned the sound off for tick strike, as you constantly hear it going off. But you can have an audio and visual alert to how strong the momentum is. So you can still see at the moment that the dollar is still seeing some buying momentum, or seeing some buying momentum here at the moment. And the key thing is with tick strike is you can change the level of sensitivity. So if you have it at level 1, that is the most sensitive to the market reactions. So whenever you see that if the dollar yen sees some movement towards the upside and it matches or it meets the requirements for tick strike to go off, then it will go off. What you want to do, or what you can do, not what you want to do, what you can do is you can decrease the level of sensitivity. So if you put it all the way up to level 15 is the least sensitive. So only when there is a big market reaction that occurs, or there's a big amount of movement that is occurring within the markets, only then will tick strike give you a visual and audio alert. So here I've put it to level 15. Everything else is kind of going off here at level 1, but level 15, nothing else is. Oh, there we go. That just happened. It kind of takes a longer time for the dollar yen to kind of, or that ticker to go off. So that's tick strike there for you. Now we want to give you a 7-day free trial to be able to have, of course, have a play with tick strike. So that is there in the chat. Oh, hey, active Imelda says, hey, information is extremely helpful. It really puts things into perspective, even for an amateur trader, and can expeditiously get with the grasp or get an understanding. Keep up with a nice job. Thank you very much. Hope you, thank you very much for letting me know that you found it useful as well. So that is tick strike. It's out for time now. So Financial Juice Pro. Now, of course, that is where you got the data release. Oh, here we go. We got some nice bit of news. So Fed swaps showed increased odds of 75 basis point hike in July. Fed swaps show expectations for Fed terminal rate of up to 3.58%, or let's say 3.6%. So again, like I said, if the non-farm payrolls data is stronger, with the average earnings also increasing, or stronger than expected, then there you go. Of course, it was only a slight tick down by 0.1%, but it's much better than the forecast of 5%. Then there you go. Markets start to price in a 75 basis point hike rather than a 50. I'll get up the CME Fed Watch tool. Actually, that'll give us a good indication of what markets are anticipating for the Federal Reserve. Okay, right. So bring that here. You can kind of see it. There we go. Okay, so if the current rate, of course, is the current rate is 1.75%, then they're looking for a 75 basis point hike at the next meeting. So they're looking for that rate to go to 2.5% at the July meeting there, right? So there's now a 98.9% chance of that happening, and 100 basis point, a 1.1% chance of that happening. But yes, so yeah, so there we go. So if you want to see the CME Fed Watch tool, which is also quite useful to see how the markets have reacted, or how strongly they're starting to price in these rate increases. I want to see actually before the release. So yesterday, not too much. Yeah, not a very big change. More or less, everyone was expecting 75 base point hike, but now is a definite there. All right, so going back to it. Okay, so Financial Juice Pro. Now, key thing is for a trader is to be able to manage their trade and manage their risk. And what investment banks do and have, they have access to a live voice and text service or a real-time squawk service. Okay, that provides them updates with what's going in the market. So here we go. We have Fed's showing increasing odds of 75 base point rate hikes in July post jobs report. Okay, updates about what central bankers are saying, people in government are saying, geopolitical events such as Russia and Ukraine, maybe it's China potential removal of the China trade tariffs or a reduction of those from the Biden administration. Those bits of news always has an effect on the market and drives the markets, right? Fundamental news. And then after that, it's a bit of technical analysis. But the key thing is it's fundamental news that moves the markets. So where's the best place to keep an eye on that and understand what's going on? Financial Juice. So in the pro version, you get no delays, get real-time voice and text service, real-time economic releases here as well on the left-hand side. And of course, if we have our need to know market risk, showing you what are the key things to be aware of for ahead of the session. So the oldest bit of news is about 8 hours, so more or less within each, covering a session, right, of what is the key focus for that bit of for that session. And looking at that bit of news, that is what Financial Juice Pro is. You also get, if we were doing non-farm payrolls with the economic trigger, if you want to do it here yourself. Now, of course, ignore this number here. This is not us telling you what to do. This is just showing you the forecast figure, and you can change it to whatever you want to be. So let's say if you were, let's say you wanted to sell the S&P 500. Let's say if you're looking for a forecast of 370k, okay, to sell if the data is much higher than that, or buy if the data is, let's say, if the actual figure comes out at 250k, just as an example, okay, not in kind of like the real world sort of thing. Now, what happens is when your trigger is set and the actual figure comes out, anything that meets your trigger or is much better than your figure, then it will, in this instance, it will show you a buy or sell sign here as soon as the data comes out. So literally within the second, you will see, boom, data comes out, and then alongside it straight away you'll see the either buy or sell sign there for you. So again, you have real-time economic triggers that we have on the Financial Juice newsfeed that is also available to you as well. Okay, so that is Financial Juice Pro. Now, what we want to do is to provide you with a 7-day free trial of Financial Juice Pro. Have a little play around with it, get to grips with how to trade news or how to manage your risk or capitalize on potential trades. Of course, you do that however you want to do it. And then, kind of have a little play around with it as well. And then, of course, we have a new product that we're bringing out, or we're beta testing at the moment, which we require your help with, which is the unusual activity beta test of a product that we've launched as well. So if you like trading stocks and trading unusual volume activity in those stocks as well, you can join the free beta test group of our new service. So that is the link there for you. Chat. Enjoy. So yeah, as I said, we're beta testing. We need your feedback, and we need to know if it helps you. There are a load of different things that we cover, and I think we're looking to bring out the different sectors. So tech sector, the industry sector, all these different sectors, kind of refine it and make it better for you. I think that was a couple of things that people were asking for. But again, the product matters from your perspective. What are you experiencing? What can you make? What do you think we should do better? Everything that we do here, even at Financial Juice Pro, right? Whatever you guys ask for, or if you any feedback you have, is always welcome. Particularly if I'm saying something wrong here, macro Ace. If I'm talking conkers, or if I am conkers or bonkers, then let me know. If something isn't working. But yes. Now, if you like this video, don't forget to like and share this video, and also subscribe to the channel. But if you want to have a look at the deviations that we provide you, okay, we've seen here in with a bit more time and to kind of digest and come up with your own strategy of trading, maybe off of how data had reacted in the past, then you can sign up to our MacroAce mailing list. Now, other than the deviations, we also provide the week ahead of what to expect. So here we go. So we have the releases that I'll be covering and what to expect for each different session. So Asia, a very brief one, Asia, Europe, the US, and the summary of the weekend news as well. So that's an email that I send out every Sunday. Okay, once a week I send out an email, unless there is an update needed during the week, if need be. But one email a week of the week ahead of what to expect is what I send out to you guys, alongside with the deviations for the upcoming releases as well. So that is MacroAce. I've provided you with a link to sign up to the mailing list. And also don't forget to sign up to, give us a follow on Twitter as well. And, show your love. And if you enjoy this video, thank you very much. Well, it's been more than 10 minutes now, so let's have a look at the movements. Let's see. Okay, so that's still up. It's about up by about 59.5 pips. S&P, the Dow Jones, there we go, being hammered. That's still being hammered. NQ, S&P, being their butts being kicked. I think somebody asked for that. Who is that? Casasa Louise. Yeah, looking at the US 30. Yeah, getting its butt kicked. Not you. The index. Just to make it clear. All right, ladies and gentlemen, thank you very much for joining me for MacroAce and the non-farm payrolls release, and also the Canadian employment change. Don't forget to subscribe and like the channel, and also show your appreciation as well to us. And I'd be really appreciative if you could also send a review of MacroAce. So if you put my email there to send a review of, if you could send a review of us and how well I did. All right, sayonara, people. Enjoy your weekend. It is hot here. I'm got my gummy energy tablet thing somewhere. Okay, it's not here. Anyway, enjoy your weekend. I will see you next week, and I'll post out the MacroAce week ahead on Sunday. Goodbye.